Welcome to More Fun with Finance. I'm Dr. William Elliott, coming to you from my studio in beautiful uptown Shaker Heights, Ohio. And this is Chapter 3 out of Ross, Westerfield, and Jordan. The past chapter, we delved into the financial statements. Here, we're taking a much deeper dive. We're going to be looking at some statement of cash flows. We're going to be looking at various types of cash flows, sources and uses of cash, things of that nature, as well as standardized financial statements. And we'll get into about 5 categories of financial ratios, each of which are going to shed additional light on what's happening with the firm, what's its financial health like. And then finally, we're going to wrap things up by looking at some of the pitfalls and some of the problems that we may encounter as we analyze financial statements. So without any further ado, let's switch over to the slides. Let me get out of the way here. And here is the outline. I already walked through that. So cash flow. We've got to look at cash flow as finance students, mainly because cash is king. You've heard that phrase, but it's really literally true. Accounting earnings are helpful, but they manipulate the cash flows a little bit with the intention of trying to make the company's earnings more realistic for a particular year. Yet, when we try to value something, we're still looking at cash flow. We don't want the accounting earnings because they include some non-cash items. Another reason we don't want accounting earnings is that accounting earnings are much more susceptible to manipulation by the accountant. And there are various ways, and there's nothing particularly nefarious about that, but it's possible for an accountant to make a choice about how to account for a particular transaction. And given that there is some choice, they may choose one way, which makes the firm look healthier than it actually is, or vice versa. So when we look at cash and we look at actual cash flows in that given period, usually a year, we get a much more realistic picture, less susceptible to manipulation, though not perfectly avoiding that problem. So, sources and uses of cash. Where does the cash come from, and where do we use the cash? So we can very simply look at this. Let me turn on the highlighter here. And, if we look at the left-hand side of the balance sheet, that is our asset side. Remember, left-hand side is assets, right-hand side is liabilities and equities. And again, you can think of that left-hand side as those are the things that the firm owns, and the right-hand side are the sources of the cash, though we can actually have sources on the left-hand side too. If we sell assets, that creates cash inflow. But nevertheless, so when we increase the left-hand side of the balance sheet or decrease the right-hand side, that is the liabilities and equity side, that is typically a use of cash. All right. Why increase the left-hand side is a use of cash? Well, think about it. Let's pick fixed assets, for example. We bought a new plant. That causes the left-hand side of the balance sheet to increase. Well, that's a cash outflow to buy that plant, and that would be a use of cash. Now, if the right-hand side of the balance sheet decreases, that is going to be, let's think of an example like, say we've got a bond issue, and we pay off that bond issue. Maybe it comes due, and we have to pay back the principal. So when we pay back that principal, that decreases that right-hand side of the balance sheet, and again, obviously is a cash outflow to the firm and thus a use of cash. All right. And then conversely, a decrease in the left-hand side or an increase in the right-hand side are sources of cash. All right. So again, a decrease in the left-hand side, we sold that plant. That generated a cash inflow. That's a source of cash that we can use for other things in the firm. A increase in the right-hand side might be a new bond issue. So we issue a new bond, and cash flows in from that, and we deploy that cash by buying assets for our business. Another way for that to happen would be, say, we have a additional equity issue. So we already have 1 million shares outstanding. Maybe we issue another 250,000 shares. That's going to create another cash inflow. So that's a source of cash. Now, mind you, usually not just one thing is going on. Usually we're generating cash and then we're using it. All right. So don't view this in isolation. If we do a bond issue, that generates cash inflow to the firm, and then we deploy that cash by buying an asset. So there's the source of the cash, and then there's a use for that same cash. All right, so here's a balance sheet. Let me just pop out of the way for the moment so we can see the entire balance sheet here. And this is Prufrock Corporation, and we've got a 23 and 2024 balance sheet here. Now, mind you, let's assume that this is, let's say their fiscal year end is 12/31. And so this would be the end of 2023. This would be the end of 2024. So in this case, this corporation had 84 million in cash at the end of 23, and it has 146 million in cash at the end of 24, for an increase of 62 million in cash in that account. Similarly, the accounts receivable were 165 in 23, and they go up to 188 at the end of 2024 for a $23 million increase, and so forth. So that's our starting point, right? We're going to elaborate more on this in just a moment. Hopefully that makes some sense to you. Just nod your head if that makes sense to you. Good. All right, so let's keep moving on. We're over here on the right-hand side now, and we've got current liabilities, we've got long-term debt, and then we have equity, the equity accounts on the right-hand side. And again, end of year 23, end of year 24, and then the change between those two. And remember, a balance sheet is just a snapshot at a given time. So this is only on 12/31 of 23 were these figures actually correct. They might have changed immediately after, and they were probably different immediately before. But at that instant, these figures were correct. So, and then under current liabilities, for instance, we had 312 million. It goes up to 344 million in 24 for a $32 million increase, and so on down the line. One thing to note here, remember this retained earnings. Retained earnings is the accumulation of net income that has not been paid out in the form of dividends or a stock buyback, right? So it's sort of got it's a little tag on it saying this sort of belongs to equity. It may or may not, literally. I mean, the funds all get used for purchasing equipment, paying salaries, buying inventory, things of that nature. But there's kind of a little earmark on these funds saying that, hey, they belong to equity because we've, in prior years, we paid everybody else. We paid a little bit of that net income out in the form of a dividend or maybe a stock repurchase or buyback. But then there's still some left over, and that gets put back into the firm, and the firm deploys that to buy additional assets. So in 2023, that was 1.799 billion, and it went up to 2.089. In other words, there was $290 million of net income that was not paid out to the shareholders, either in the form of a dividend or a stock buyback. And then, of course, down at the bottom here, we have the total liabilities and equity. And, of course, that has to match up with the total assets on the left-hand side of the balance sheet. All right? Everybody good so far? Good. All right. So now let's go on to looking at the sources of cash and the uses of cash. So each one of these comes straight off of the balance sheet here, all right? But if we start off with a source of cash, an increase in accounts payable. Well, let's go back here and let's look at this slide. Let me clear this off and clean it up a bit. So we were saying that an increase in assets or a decrease in liabilities or equities is a use of cash. So increase in assets, decrease in liabilities, use, increase in assets, decrease in liabilities and equity. And then a source of cash would be a decrease in assets or an increase in liabilities and equities. All right, now let's go through this list. Increase in accounts payable. Well, think about it for a moment. Where is accounts payable? Left-hand side or right-hand side? Here's a hint. Yeah, it's on the right-hand side, right? All right, so accounts payable, if we just use this little note up here, an increase in accounts payable, since it's a liability, would be a source of cash. Well, why is it a source of cash? Well, because we've been able to borrow from one of our vendors, one of our suppliers, more than we were borrowing before. So we had previously, at the end of 23, we had $312 million in accounts payable. That's basically a debt that we owe to our vendors or suppliers. That went up to $344 million. So now we basically got $32 million worth of additional things from our vendors and suppliers. Now that's going to show up obviously on the left-hand side, probably in the form of inventory, right? But for the moment, that actually provided us with a source of cash. So that's 32 million there. There was an increase in common stock. And again, if we go back to the right-hand side of the balance sheet, that is right here. $50 million increase in common stock. So some point during the year, the firm sold additional common stock. So that extra 50 million is cash that we have to use. Another 290 million came from our earnings, the net income that was not paid out to stockholders. Whatever was left over, that was 290 million. This gives us a total of 372 million in cash that we generated over that period. All right. Now, how did we use that cash? Well, we used a portion of it because our accounts receivable went up by 23 million. Well, accounts receivable is kind of like the flip side of accounts payable. In other words, it's one of our customers or multiple customers who we have sold items to, but they still owe us money for those items. So that's a debt. Basically, it's a loan that we have made to our customers. So that account went up by 23 million. So that used up some of this 372 million that we have in cash. Another thing that happened was that our inventory went up by 29 million. And by the way, like I alluded to earlier, that probably is why our accounts payable went up by 32 million too. Notice that they're pretty close amounts. I'm not sure what else went on here, why our inventory didn't go up by that full amount, but maybe we used more of it up during the year. There was a decrease. So, by the way, and to keep track with this little notation here, accounts receivable are on the left-hand side. That was a increase in an asset, so that would be a use of cash. An increase in inventory is also a current asset. That's on the left-hand side, so that is another use. Decrease in notes payable. Well, that is a decrease in a liability. So again, that's a use. Decrease in long-term debt. In other words, we paid back some of our long-term debt. We may have paid off a bond, particular bond issue. And then net fixed asset acquisition. That's an increase of an asset, a long-term asset. So again, that's obviously a use of cash, and that was $149 million. Let's pop back over to the left-hand side just to see where that 149 came from. And yep, there it is, right down here. So we increased our plant, property, and equipment from $2.7 million to $2.88 million. All right. Everybody see where all of these come from? With some practice in the homework, hopefully this will start to become second nature to you. Now, total uses were 310. So note that of the 372 in cash that was generated during that period, we only used 310 million. So where did the rest of the cash go? Well, it went into the cash account. So the amount of cash went up by that difference, that 62 million. Let's just go back over here and make sure we can see that. Yep, there it is. Right here. There's our 62 million. And cash went from 84 up to 146 million at the end of 2024. All right. Good so far? Now we're going to look at this income statement, and that will allow us to not only look at sources and uses of cash, but we'll also be able to actually construct a statement of cash flows. So here we have sales, 2311. Cost of goods sold is 1344. Depreciation 276 for a EBIT of 691. Then we have interest that we paid back to our note and bond holders of 141, leaving us with an EBT, or taxable income, of 550. And our tax rate, assuming a 21% tax rate, is 116 million, leaving us with net income of 435. Of that 435, we paid out 145 of that in the form of dividends to our shareholders, and that means the remaining $290 million is kept by the firm and then reinvested into assets. All right. So now, statement of cash flows is something that is generated from the balance sheet and the income statement. These cash flows are broken up into basically three main categories. And the first one is operating activities. That is the business. What are we doing as a business to generate cash flow? The second one is investment activities. So what are we investing in that is a long-term asset? And then finally, financing activities. How are we generating these cash flows? Where's the source? Is it from bonds or is it from stock? Now, there is a little bit of latitude that accountants have in terms of how they categorize a particular activity into one of these three categories. So depending upon who's creating the statement of cash flows, it might vary a little bit. All right, so here is our statement of cash flows. And I'm going to change the color on this marker. And so here we have operating activities. And so we start off with the net income. And again, that comes from our income statement right here. All right. And we're going to add back depreciation and an increase in accounts payable, because that's all related directly to the operation of the business. The reason we have accounts payable is that we have purchased inventory or other items for the company, and we've been extended credit by the vendor, the supplier of those things, minus the accounts receivable increase and the increase in inventory. So now we have net cash from operating activities of $691 million. And that's a positive. That would be a cash inflow to the firm. Now, what did we do in terms of investments? And here we're always looking at long-term assets. So we had our fixed assets went up by $425 million. So that was a use of $425 million. So we're done with investment activities and operating activities. Now on to financing activities. So what happened on the right-hand side of the balance sheet? We had a decrease in our notes payable. We had a decrease in long-term debt. So we're paying back some of our debt. We paid out $145 million in dividends to our stockholders. And then we sold some stock during the year. This is new. These are new shares. This would be what's called a seasoned equity offering, an SEO. I'm assuming here that the company is already a publicly traded company. It's already done its IPO. But after the IPO, then a company is free to issue additional shares as they need funding. So that extra $50 million came from an SEO, a seasoned equity offering. And so on net, our financing activities were a negative. In other words, it was a use of $240 million. So we have minus 240, we have minus 425, and we have a positive 691. And when we do that math, we end up with we end up with a increase in cash of $62 million, meaning that our year-end cash is $146 million. The prior year-end cash was $84 million. Notice right here and right here. All right? Good. All right, let's keep rolling along here. Now, this slide shows us the same series of cash flows, but organized a little bit differently. Here it's organized as, let me just zoom in on this so you can see it better. This is sources of cash, and then down here we have uses of cash. So just a different organizing method. Everything else is the same in terms of the actual numbers here. And obviously when we get down to the bottom, we had a $62 million excess of sources over uses. So that meant that our cash balance went up from 84 million up to 146 million. All right. Okay. So now let's let me slide over here to the right, get back out of the way. Let's look at another way of viewing financial statements. Standardizing something means usually scaling it by some denominator, right? When we standardize anything, we're usually doing that to try to compare it to something else. So here we're doing the same thing. With each of our financial statements, what we're going to do is we're going to scale the balance sheet by total assets, and we're going to scale the income statement by the revenues, net revenues. All right, so in this slide, again, I've got to get back out of the way because I'm blocking part of this. All right, so here again we have our year 23 and year 2024. Now, here are the amounts that you are already familiar with from the prior slides and so forth, all the way down to total assets here. Now, if we were to take, let's start with the cash first. So if we were to take 84 million and divide that by the total assets of 3.373 billion, 373, that would give us 0.025 or 2.5%. And note, there you go. There's 2.5%. So in other words, cash is 2.5% of total assets. Accounts receivable is nearly 5%, so nearly double of total assets. Inventory is almost 12%. And the entire current assets make up 19% of total assets. So that means that 81% of our assets are tied up in long-term or fixed assets, plant, property, and equipment. So that's a typical common size balance sheet. And right now we're just looking at the left-hand side, but we can certainly look at the liabilities and equity in the same way. We're going to divide those by, you can think of it as either total assets or liabilities and equities. Remember, assets equals liabilities plus equity, so it's the same number. All right, let me clear this off, and let me switch over to the pencil. We have the same thing here for 2024. Notice that cash, actually in this case, went up by quite a bit, from 2.5% to 4%. Accounts receivable seem to stay about the same. Same thing with inventory. All right, so here when we look at common base year assets, we're taking a particular year and we're saying we're going to compare everything to that year. So in this case, we're just comparing the end of 2023 to the end of 2024. So in the case of, let's take cash to start with. At the end of 2023, it was 84 million and it went up to 146 million. How big a change was that? Well, 146 over 84, that's where that 1.74 comes from. And basically, you can think of that as a 74% increase in cash. Similarly, with the accounts receivable, 165 million up to 188. Again, 188 over 165 gives us 1.14. And so there we have our common base year for cash and accounts receivable, 1.74 and 1.14 respectively. So in other words, this the number after the 1 tells us the percent increase. Now obviously if it's less than 1, there was a decrease. But in this particular situation, everything went up. And actually, overall, total assets went up by 8%. All right? Now, this one is pretty straightforward, so hopefully that makes some sense to you. What gets a little less straightforward is the common size combined with a base year. Okay, so when we combine common size with a common base year, okay, notice that this asset, total assets, is 1. That's what we're doing. We're trying to scale the assets. We're making that common size. And so we're looking at 2024 in particular. Notice that since we're saying that 8% is we're basically assuming that if everything moved up by 8%, that all of these figures on this last column would be 1. In other words, net plant, property, and equipment would be 1, total current assets would be 1, and so forth, if everything went up by exactly 8%. So we're scaling by this 8%. So we're still comparing it to that base year of 23, but we're looking at the 2024 year. Now, and in fact, everything did not go up by 8%. In fact, cash went up by considerably more. It went up by an additional 61%. And how did we get that? Well, we took the 4% and divided it by the 2.5%. And that gave us 1.61, or a 61% increase relative to the 8% that's already baked in. All right. Accounts receivable also grew at a faster rate. And so that is 1.06. And again, that would be 5.2 divided by 4.9 equals 1.06. Notice here, however, that inventory actually grew at just about 8%. So there's some rounding error in here. So that's why inventory actually is a 1 in this far right-hand column. Total current assets grew a little bit quicker, and so that's why we get a 1.09 here. PPE was a little bit slower, but since it's such a big piece of the pie anyway, that drags us, that'll drag down our overall total assets down to the scale of 1. By definition, that's what we're doing anyway, though. All right. Hopefully that makes a little more sense now. Typically, we don't see, in the real world, I don't see this done too much. I do see this common size done a lot. It's really helpful. I mean, certainly combining it with some base year is helpful too, to look at some sort of trends and see where things are heading. But the common size balance sheet is very useful and widely used. All right, now let's jump in. And let me back up, because we hadn't mentioned that we can do the same thing with the income statement. Now, in the case of a common size income statement, we do not scale by total assets. We scale by total revenues. And that's the top line of the income statement. So everything is as a percent of total revenues. All right, on to financial ratios. This is where we get a little bit deeper dive into what's happening with the firm. Certainly these common size statements can be helpful, but financial ratios take it even further. We break these up into 5 main categories. 1 is short-term solvency or liquidity ratios. 2 is longer-term solvency, financial leverage ratios. 3 are asset management and turnover ratios, i.e., I think of these as efficiency ratios. Number 4 is profitability. And then the 5th category are market value ratios. So the categories 1 through 4 use accounting numbers. The 5th category actually blends market data with accounting data. One thing to note here, and this is important, depending upon who is calculating a particular ratio, there are different ways to do it. There are certainly some preferred or recommended methods, but be careful if you're comparing one person's ratio, profitability ratio, with another person's profitability ratio, they may have computed it slightly differently and gotten different figures. That's not uncommon, especially when it comes to things like a PE ratio. A PE ratio is one of these market value ratios, and the earnings are depending on how we estimate earnings, whether they're backward looking or forward looking, we can get very different PE ratios. So this is something to keep in mind. The other thing to keep in mind when it comes to these ratios is that if we are using ratios that are pre-calculated by Yahoo Finance or Zacks or Bloomberg, my preference is to always go back to that same source, right? So if I'm comparing 5 different companies, I don't want to get some of the data off of Yahoo and some of it off of Zacks and some of it off of Bloomberg. I want to get all of the same ratios from that same source, because then they're calculated in the same way. One of the advantages of the Bloomberg terminal that we have down in the lab is that they will actually describe for you, if you right click on any of the variables, they'll describe for you exactly how they computed it. So I like that a lot, because at least I know how they're doing it, and they're doing it the same way for all of the firms in their database. All right, so let's start with these short-term solvency ratios. The two biggies here are current ratio and quick ratio. Certainly these others are useful, but nowhere near as widely used as the first two. Current ratio, what's that tell us? Well, it tells us how much current assets we have relative to current liabilities. So how quickly could we extinguish those current liabilities? You can think of it that way. The quick ratio is a little bit more stringent in that it subtracts, that should be a minus sign there, it subtracts off inventory from current assets. And the reason we do that is that inventory is often not well reflected in the financial statements. In other words, we might have bought some inventory years ago. It's still in our inventory, and we paid a lot for it, but today it's worth almost nothing. Or maybe there was some degradation in the items as they've sat on the stockroom shelves, something of that nature. So when we subtract out inventory, that gives us even a better measure of, hey, how quickly could we pay off those liabilities by using the current assets? So those two ratios are really important. Cash ratio, again, even more stringent than the quick ratio, because here we're just using cash on hand to pay off liabilities. Now, it's not uncommon for this ratio to be less than 1. And mind you, I should also mention that any of these ratios in and by themselves don't have a lot of meaning. It's only when we compare them to something else or we have some sort of benchmark that it becomes useful. So, let me give you an example. Let's say that we have a quick ratio of, let's say that it's 1.2, and we have a cash ratio of 0.8. What does that actually mean? Well, I always like to think about this as there's that latent denominator in here. So it's really 1.2 over 1. So the numerator is current assets subtracting off inventory. So that's 1.2. And current liabilities is basically a 1 in here. So what this means is that for every dollar's worth of current liabilities, we have $1.20 worth of current assets. And these are typically, it's cash and accounts receivable, right? So those are obviously, cash is cash, and accounts receivable, we might have some bad debts. It might take a while to collect some of it. But generally speaking, we can convert most of that accounts receivable into cash. pretty quickly. So that means we're in pretty decent shape in terms of being able to pay off our current liabilities if we wanted to. We're not going to do it, but it's helpful to know that we could if we needed to for whatever reason. Now, as I said, that's helpful, but I don't know whether 1.2 is that good or bad. Well, if I look at the industry average and I see that the industry average is 1.8, 1.2 is not so good. If I look at the industry average and that's actually 1.1, then 1.2 is certainly in line and maybe even a little bit better than the industry average. Similarly, with this cash ratio, let me clear off this mess up here. With the cash ratio, again, we have that latent 1 in the denominator here. So when we're looking at that, that's $1 worth of current liabilities and 80 cents of cash. So we only have 80 cents of cash to pay off $1 worth of liabilities. And again, is that good, bad, or indifferent for a particular firm? Again, we need to know whether that firm, how it compares to its industry average or peer firms. Then these last two, net working capital to total assets, again, is a measure of how capital intensive our firm is. And again, this one varies considerably from industry to industry. Some firms don't have much in the way of long-term or fixed assets, so this ratio would be very high. Other firms have a lot of long-term assets, and the ratio would be considerably lower. And then finally, we have this interval measure, and that is current assets scaled by average daily operating costs. This interval measure is a measure of how long can the firm operate given its level of current assets. And again, I should actually note here that when we have an item that's off the balance sheet, like current assets, and an item that is off the income statement, the average daily operating costs, which by the way is cost of goods sold plus operating expenses. And then, of course, we're going to divide that by 365 because there are 365 days in the year. Notice that that income statement being a flow, in other words, it's over a span of time, whereas the balance sheet is a snapshot at the beginning and at the end of that time. So typically what one does in that case is that the balance sheet item, this current assets item, we would want to take the beginning current assets, add to that the ending current assets, and divide that whole thing by 2. That way we get an average of the current assets over that year. So if we end up with 200, 300, 400 days, whatever the number of days is, usually the higher means the better financed or the more solvent the company is. Now, we want to be a little bit careful there because we also want to use those current assets efficiently. We don't want to have a whole pile of cash sitting there because cash doesn't do anything. I mean, cash is cash. We don't want too much in the way of accounts receivable, obviously, either. We certainly want to collect those, so we don't want to get that too big. We also, in terms of inventory, we want to keep our inventory levels low. So while from a solvency standpoint, more days is better, from an efficiency standpoint, that's not it's not a given. So be careful with that particular ratio. Here's just some of the things I've already mentioned, just additional highlights about current ratio, quick ratio, cash, net working capital to total assets, and then interval measure. Okay, so let's move on to long-term solvency ratios. These relate predominantly to financial leverage, right? Financial leverage is the amount of debt that we use to finance the asset base relative to the amount of equity that we have on the balance sheet. These first few are fairly typical and really all relate. You could look at either one of any of these three, and you would get a basic estimate of how much debt versus equity. It's all a matter of preference. I often like to look at simply the total debt to assets ratio. That's a very easy one because as we have an all equity firm, that would be 0. A firm that has 50% debt, 50% equity, that would be 0.5 or 50%. If it has 75% debt, 25% equity, this ratio is 0.75. So it just makes it easy to think about in that regard. However, these other two really have the same meanings, right? Whether we're looking at total debt to equity, so 50% would be 1 to 1, $1 of debt for every dollar of equity, and so forth. Total assets over equity, equity multiplier. This is a handy one because, as you'll see in a few minutes when we talk about the ROE decomposition, or what's also known as the DuPont analysis, the equity multiplier is the ratio that is part of that analysis. But again, as I said, all three of these mean exactly the same thing and give you the exact same information. So you could use any of these three, whatever is convenient for you. This long-term debt over total long-term debt plus total equity, again, is a measure of leverage. However, the focus here is on how much long-term debt is there relative to equity. We're leaving out that short-term debt piece. The rationale is that long-term debt is, is something that is more likely to cause a problem. Short-term debt, current liabilities are very short-term. They're less than a year. If we can't cover that, we're in deep trouble anyway. So this measure gives us, a better capture of long-term solvency. These last two really look at how well we can cover our interest payments. And those are due, every year, maybe quarterly, depending upon the contract. But this times interest earned or interest coverage ratio is a very widely followed one when it comes to looking at solvency. If it's not greater than 1, we've got some potentially big problems, right? If we can't cover our interest using the earnings before interest and taxes, we might be in trouble. This second one actually is a little less stringent than the times interest earned, and that usually goes by TIE. This one recognizes the fact that depreciation, which if you think about the income statement, you've got revenues, cost of goods sold, operating income, and then you bring out depreciation before you get down to EBIT. Well, depreciation is a non-cash expense. So from the perspective of the income statement, we subtract it off. But from the perspective of do we have enough cash to cover our interest payments, we can add it back in because we're not using cash. So it's less stringent. So if your times interest earned is less than 1, but your cash coverage ratio is greater than 1, you're still probably okay. And then here are some additional notes that I won't, I'll leave that to you to look at. Then we move on to some asset management, turnover ratios. I also think of these as measures of efficiency. So, variety of things to look at here. These two kind of group together and give us the same information. Turnover, inventory turnover, cost of goods sold is what we take out of inventory relative to the current inventory. So that tells us how many times in a year we might turn over our inventory. The days sales in inventory gives us a similar idea, except it tells us how many days it takes us for that turnover. Same thing here with receivables and days sales receivables, except instead of inventory, it's receivables, accounts receivable rather. And so again, this measure and this measure really are getting at the same thing. So you can look at one or the other. You don't have to look at both in particular. Net working capital turn, and by the way, these two things, inventory and receivables, are the most widely looked at. Then net working capital turnover also gives us a measure of how efficiently we are using our working capital. Fixed asset turnover gives us a measure of how efficiently we're using our long-term assets, plant, property, and equipment. And then finally down here, let me get out of the way, sales over total assets. This just gives us an idea of how well we're using our total asset base to generate sales. And again, remember that little trick. So let's say that we have a total asset turnover that is total asset turnover equal to 3.5, let's say. Let me get out of the way here. Remember that implicit 1 down here. So we can read that to say that for every dollar worth of assets in a given year, we're generating $3.50 worth of sales. And again, is that good, bad, or indifferent? We don't know until we compare it to a benchmark, usually something like an industry average or a peer group of firms that are similar in the similar business. But anyway, keep that in mind, that there's always, whenever you see a number for a ratio, there's always that implicit 1, and it helps us to interpret what that ratio really means. Okay, so these are measures of efficiency. And again, notes on that. And then we come into our profitability ratios. All three of these are just super important. We're going to look at all three, and any investor or analyst, investment analyst, is going to look at all three of these. Profit margin tells us basically how efficiently we convert revenue into net income. And again, this is just income statement, right? So we're at the very top. We've got sales, right? That's in our denominator here. At the very bottom, we have net income. That's in our numerator. And so, you may have a profit margin of, say, 20.25. Well, what's that mean? That means that for every dollar worth of sales, we end up with 25 cents of that goes towards equity, or it belongs to equity, if you will. Return on assets takes that same net income figure, and instead of scaling it by sales, it scales it by assets and gives us an idea of how profitable our asset base is. And again, the higher the figure in all of these cases, the better. And then finally, the all-important return on equity, which tells equity stakeholders, that is stockholders, how well they're doing. So again, numerator is net income, but in this case, denominator is total equity. And note that in both the ROA as well as the ROE, we have one item from the income statement, we have one item from a balance sheet. Since the income statement is a flow and the balance sheet is a stock or a snapshot, if you will, at the beginning and end of the period, we're always going to be taking the average of our balance sheet items. So we're going to take the average of total assets from the beginning to the ending of the period, the average of the total equity. Another thing to note here, and this is also very important, is that these figures off the balance sheet, total assets and total equity, those are book values. In other words, that's what the total assets were back when we bought them and recorded them on the balance sheet. That's what the total equity was back when we first issued that equity. Neither of those figures may be the same if we're talking about market values. And again, market values really are king. And we're going to be jumping to those in just a moment right now. Here's some additional notes on those profitability measures. Now this is our last category of ratios, market value ratios. So in all of these, one or both of the parts of the ratio come out of the marketplace. So it might be price per share, as in this PE ratio. So this would be usually referred to as PE ratio. And it's price per share over earnings per share. So price of the stock over EPS. This particular ratio is probably the most widely cited ratio in all of investments, and so a very important ratio. It has some serious problems, though, and that is that this price is a very forward-looking measure. Anytime you price something, you're thinking about what's it worth, not what was it worth, but what is it worth and what is it going to generate for me in terms of dividends and any sort of capital gains into the future, not what happened in the past. Now, the past is certainly helpful. We have a very stable company that's been generating a good profit for decades on end. We hope that we can continue that or see that continue. But still, there may be changes. There may be changes in the external market, changes internally in the company itself. Nevertheless, that price figure is always forward-looking, whereas if we take last year's EPS, or what's known as trailing 12 months, TTM, that's back there. That already occurred. The price that's in the numerator is what investors are expecting to occur in the future. So, not a very good matchup there, right? And this was most evident when we came out of COVID, for example, where we had really terrible earnings that last year as we were coming out of the COVID shutdown. But the price was looking forward to really top earnings. So we had really high PE ratios. Well, it's not because that meant anything. It was just that there was a mismatch between the numerator and the denominator. Now, in some cases, you will find that analysts will actually look at price divided by expected EPS. So this is an estimate that they're making of what the EPS might be in the future. Now, those ratios tend to be more stable. But the problem is that this is going to vary from analyst to analyst. It's the future. So nevertheless, just be careful of PE ratios. The PEG ratio takes the PE and ramps it up one level by so we're going to take the PE ratio and we're going to divide it by the earnings growth rate. All right. And this is important because high PE firms are thought of as having very high growth rates. And if they don't have really high growth rates, then we're going to get a very high value here. And that might be indicative of a firm that could be overvalued. So PEG is another kind of a derivation. It's a variation on the PE ratio. Price to sales, again, numerator is the stock price on a per share basis. Denominator is revenue divided by total shares outstanding. Big problem with this ratio. I would recommend that you never use this ratio unless you absolutely can't get a PE ratio. When can't you get a PE ratio? Well, when the company is not turning a profit. It might be a startup and all they've got is revenues and everything else is negative from there on down. Operating profits, EBIT, EBT, all of those things are negative. That means we can't get a PE ratio, but we could get a price to sales. The reason that I recommend not using this ratio, unless you absolutely have no other choice, is that price is the price of equity. Equity gets what? What do they get out of the company? If you said net income, you're absolutely right. Net income is what they get. Well, where is net income on the income statement? Well, it's at the very bottom, right? We've got sales up here. Net income is at the bottom. And between there, we've got inventory costs, we've got wages and salaries, we have depreciation, we have interest, we have taxes. All of that comes out and goes to somebody else. Now, if we're comparing one firm's price to sales with another firm's price to sales, the amount of the cost of goods, the wages, the interest, the taxes, all of those are different from firm to firm, depending upon a lot of factors. So they're not comparable. So stay away from this if you can at all possible. Price to sales ratios, yeah, they're okay for brand new companies that don't have a positive net income, but other than that, not a good choice. Market to book is another very widely used. So between price to earnings and market to book, both of those get used extraordinarily frequently. Market to book, and by the way, this sometimes is actually reversed. Book to market depends on the school you went to. Certain schools will talk book to market. Others, I don't know. Don't ask me why. But let's use what the authors use here, market to book. And so basically it's the market value per share, which is the same thing. Let me clear off this mess that I've got so far. And I'm going to go back to a highlighter. So price per share and price per share, market value per share, those are all the same figures, right? You could actually say price per share in there. That's exactly the same figure. The book value per share is where we go to the balance sheet. We take the total value of the common equity, including retained earnings, and we divide by the number of shares that have been issued. And that gives us book value of equity. All right, so this is market value of equity divided by book value of equity. So what does that actually tell us? It's an interesting figure. Some people think of it as, kind of a measure of the potential growth. So if I have, say, a market to book of 4 or 5, for every dollar of equity I have on the balance sheet, the market's willing to pay $5 for that dollar's worth of equity. Well, the only way that's profitable is if the firm is going to grow really quickly. Same thing with PE, right? I mean, a high PE is indicative of a high growth firm. However, with market to book, there are some other factors that come into play, and that is that maybe the market is just mispricing this stock. We might have a high market to book because part of that level is mispricing, kind of overly optimistic about the firm. So it could be part of it is at least is a mispricing component. The other problem with this is that we've got book value per share in the denominator, and anything off the balance sheet is recorded at historical values. And depending upon, say, we're comparing one firm to another, they booked those assets at different points in time. They may have different values. And yet a third element that I often think about is that what makes this firm special? Well, it's not only the combination of the assets and the opportunities, but who makes those opportunities come alive? People. So people are not on the balance sheet. The workforce is not recognized anywhere on the balance sheet. So what makes these assets really valuable to the marketplace might be a Steve Jobs and everybody that Steve hires to work for him, all of the talented engineers at Apple. It's not so much the assets, it's the people, and they're not captured anywhere on this balance sheet. So they might still have a high market to book simply because they have such great personnel and talent. These last two ratios are less widely used, especially the Tobin's Q. Tobin's Q is more widely used in research. Tobin skew is interesting in that it says, let's take the market value of the assets, and that market value actually is going to be calculated as the market value of equity plus the market value of the debt. Market value of each of those, that together would be the market value of the assets, divided by the replacement costs of those assets. So that's the numerator is the right-hand side of the balance sheet. The denominator is the left-hand side of the balance sheet. Except instead of historical costs, we're going to go out and we're going to look at what would it cost to buy those assets right now, today, in today's dollars. There again, we're capturing things like what are the people doing? How do they add value to it, since people are not a part of either the numerator or denominator. But Tobin's skew is a good measure to use. It also can capture these growth options. In other words, what potential future growth does the company have? Maybe because of patents that it holds, maybe because of some talented researchers that are in their R&D department, things of that nature. And then finally, we come down to enterprise value to EBITDA. And EBITDA, let me just talk about that briefly. That's earnings before interest, taxes, depreciation, and amortization. All right? So EBITDA, and that's sort of like, you can almost think of it as something like a cash flow left for bondholders and stockholders. Now, enterprise value also is something that we haven't touched on yet. And enterprise value is essentially the value of the firm minus cash, and that's excess cash. You probably can't see that. I should change that pencil. Excess. Oops. Let me change the color to red. Excess cash. Well, why cash? What is it about cash? Well, first thing, what's cash worth? Cash is worth cash, right? $100 is worth how much in the marketplace? $100. It's very clear. Now, what's this excess bit? Well, there's a certain amount of cash that's required to run the firm on a daily, monthly, year-to-year basis, right? That's part of running the business. We have to have that cash to tide us through. Maybe we have a seasonal business. We make all of our money right before Christmas, but we need cash for the first 3 quarters to get to that high season where we make most of our profits. Excess cash is the amount of cash beyond that. So many firms end up with billions of dollars sitting in their cash account and don't actually need it to operate the business, but they haven't recognized it, and they haven't done anything with it. It's just sitting in cash. Now it might be in short-term, some sort of short-term investment, things of that nature. It might be in preferred stocks, convertibles, things of that nature. However, it's excess. It's extra to the business. So we subtract that off, and then we just have the firm as it's and with a sufficient amount of cash to keep it operating. And then this EBITDA piece of it is that cash flow that's available to the bond and the stockholders. One other thing I meant to mention, this excess cash is often the case when we have a firm that's a startup. So they might have the war chest of cash to get them through the next 2 to 3 years until they start making a more sustainable profit. So again, it's not required to actually run the business on a day-to-day basis, but it is required to get the company up and operating. So we typically subtract that excess amount off, and that value of the firm minus the excess cash is what's known as the enterprise value. All right, so that's it in terms of our ratios. Now, there's another ratio or another analysis using ratios that is very important. This is called the DuPont identity. I call it DuPont analysis. Others will call it simply ROE decomposition, which is really most illustrative. But essentially what we're doing here is we're taking the return on equity, which is net income divided by total equity, and we're breaking it up into at least 3 and sometimes 4 and 5 components depending upon our purpose. We're just going to look at the 3-component decomposition here. And so what they have done here is they're kind of walking you through the process on this slide. The authors do this in the text as well. They say, well, okay, so return on equity, it's, let me go back to a highlighter. So return on equity is net income divided by total equity. Now they say, well, why don't we take another ratio and multiply that first ratio by assets over assets. Well, what is assets over assets? Let's say assets is $3.5 billion. Okay, so 3.5 over 3.5. What's that equal? Yeah, it's 1, right? Yeah, exactly. So we're multiplying this ROE by 1. So we don't change the ROE at all. Now, let's rearrange these terms a little bit, and let's slide the assets over here and move the total equity over here. And what we end up with is this thing. So now we have net income over assets times assets over total equity. Notice that the assets will cancel out and we're left with net income over total equity. So we haven't really changed anything, but we do have 2 ratios now instead of just 1. All right, well, what is net income over assets? Yeah, if you go back to that category 4, that's the second profitability measure, isn't it? It's ROA, return on assets, net income over assets. That's ROA. So now we have ROE as a function of ROA and then this other thing, the equity multiplier. And again, if you'll go back to long-term solvency ratios, and remember that that was, I think, the 3rd ratio we talked about in there, that's a measure of leverage. How much debt relative to how much equity. So now we have a little better sense of what's driving this ROE. Is it because we have a great return on assets and almost no debt? That could be it. Maybe it's that we have a moderate ROA and a really high leverage ratio, a lot of debt. That could also lead to a high ROE. Let's go back to that slide on long-term solvency. Right here is our equity multiplier, right? Total assets over total equity. So the higher that ratio is, the more debt we have. Again, remember, total assets over total equity. And so let's say that's 5. Well, for every $1's worth of equity, we have $5 worth of total assets, meaning that $4 of that total assets is supported with debt. So we'd have 80% debt. It's a really high leverage ratio. Most firms don't have that high a leverage ratio, but you might if you have a lot of fixed assets that are collateralized. Most total assets to equity ratios are below that. But you get the idea. The higher that ratio, when we go back here to our decomposition, the higher that ratio, the higher is going to be the ROE. So if we want to crank up ROE, we can do it one of 2 ways. We can increase our return on assets, or we can increase our equity multiplier by taking on more debt. Either or will do it. Now, there's yet one other ratio we're going to add in here, and that is we're going to come down here and we're going to multiply these two ratios here by sales over sales. And again, whatever sales over sales is always equal to 1, so we haven't changed the formula at all. Okay, so now we're going to take this sales over sales and we're going to swap the sales over to the right and we're going to bring the net income over to the left. And what we're going to end up with here is net income over sales, which is profit margin. Again, go back to the profitability measures in category 4. And we have sales over assets, which is a measure of efficiency or asset turnover. And we still have the equity multiplier. So now we've broken up ROE into 3 component parts that we can much more easily understand. And that is, how well do we convert revenues into net income? How efficiently do we utilize our resources, our asset base? That's the total asset turnover. And then how much do we fund our asset base with debt? And again, the higher the asset turnover, the higher the equity multiplier, and the higher the profit margin, the higher the ROE. And it could be one is really high and the other two moderate, or vice versa. But that gives us a better sense of what's happening inside the firm. It's not the end of the story, but it gives us a clue. I think of working as an analyst, especially when we're doing some sort of security analysis. I think of that as very much like an investigator. You're trying to figure out what happened. You're a private investigator. You're looking for who is what was the crime and who did it. Here we're looking at what's the profitability, how did the firm become this profitable, what's preventing it from becoming more profitable. And then we're also comparing all of these ratios for the subject firm with benchmarks using peer groups or industry averages. So this DuPont identity, DuPont analysis, or just simply ROE decomposition, all synonyms for one another, is a very helpful technique when we are attempting to understand what is the value generator in a particular firm. Here's some examples comparing, say, Amazon to Alibaba. I'll let you browse through that. Statement analysis and this ratio analysis that we've been talking to is not only useful for the management team of the firm itself, because obviously they want to maximize profit for shareholders, but it's also useful to creditors. It's particularly useful to investors and analysts who are trying to uncover the value of a particular firm. It's even useful to suppliers and large customers because they want to deal with a firm that's going to be around for a while. Credit rating agencies use this sort of technique. The competitors are even looking at each other, right? So you're looking at your competitor firms, trying to figure out what are they doing right? How can we be better? How can we crank up our ROE? That sort of thing. And then also when it comes to M&A, mergers and acquisitions, any potential bidder firm that is an acquirer is looking at other firms using these sorts of techniques. So these are very widely used techniques, and these ratios and the common size financials and things of that nature are extremely important to understand quite well. How do we choose a benchmark? Well, that's always the devil is in the details. It's not easy. I'll tell you that, because when we start looking at firms on a industry or sub-industry level, it turns out there aren't that many firms in a subgroup of a subgroup of a subgroup. The SIC codes, that is the Standard Industrial Classification Codes, SIC, are what are commonly used. Now, there's a new system out called the North American Industry Classification System, NAICS, and that is it's been around for quite a while, but it still has not become widely used. So many people still talk in SIC codes. But basically, these are classifications of industries, really starting at the sector level, which is the broadest definition, down to, say, a subsector level, down to an industry level, down to a sub-industry level. So there are 4 digits in an SIC code. The leftmost digit is the sector level. The second from the left is the subsector. The third is the industry, and then the fourth is that sub-industry. By the time you get down to a 4-digit match, sometimes you might only have a handful or less firms in that 4-digit match. The other problem with simply blindly using SIC codes, especially if you use less than 4 digits, maybe you only use a 3-digit match or a 2-digit match, is that these things are self-identified. So a company, and you can only pick one as your primary SIC code. So you got a company like GE, General Electric, a conglomerate. They can only pick one SIC code to represent GE. I mean, GE has dozens of different businesses and very different from light bulbs to jet engines. And there's very into medical equipment and things of that nature. Very different businesses that are going to have very different benchmarks. So picking a benchmark based simply on industrial codes like SIC codes or even NAICS codes is really problematic. Probably a better way to do it is to look individually at the firms that you're going to include and create some sort of peer group that you think, as an analyst, you think are the closest matches to the firm. Because the closer the match, the better the information you're going to use to compare against your subject firm. Here's just a list of some of the SIC codes. These are simply 2-digit SIC codes. So within the mining sector, we have metal mining is 10, bituminous coal and lignite mining is 13, oil and gas is 13, or sorry, 12 for bituminous coal, 13 for oil and gas, etc. Same thing with construction is 15 for building construction and 16 for construction other than building, and then special trade contractors is 17. But again, remember, all of these are self-identified by the firm itself, and they can only pick one as their primary SIC identifier. What are the problems with it? Well, I've already mentioned one of them, and that is that when we have conglomerates, we can't really look at the entire firm and compare it to anything. We might be able to look at segments of that firm, break it out into its individual business segments. Sometimes you'll find that on the financials. Sometimes it's a little more difficult. But that's one way. So you could value each segment and then add them up to come up with the value of the conglomerate. The problem that we have with international firms is that they may not necessarily follow GAAP principles, and so they're using a different accounting technique, which may mean that the numbers that we're observing are different or not comparable, I should say. So that's a problem. Even something as seemingly minor as when the fiscal year end is might create some problems for you when you're doing an analysis. So always be on the lookout for those sorts of issues. And that pretty well brings us to a close on this chapter. I hope that you have picked up a lot of extra tips out of this. Obviously, I'm hoping that you'll either have already done the reading and then watch the lecture, or maybe watch the lecture and then do the reading. Either way you do it, getting multiple exposures to the material is very important and very useful. So I will leave you with that and see you in the next chapter. Good night.